The best built investment portfolio will not achieve superior results if it's plagued by bad habits. This factually true statement is borne out time and time again. And so what I'm telling you is that if you want to have profitable investment results, you better start cultivating the right habits. And that's the purpose of this video series titled Habits of the Investing Greats. I'm going to give you one habit. I'm going to link that one habit to an investing great, and then I'm going to tell you what to do about it. So what is today's habit? It's that of being consistent. And when it comes to investing, the stock market doesn't beat anyone because people beat themselves. And they do that by doing the wrong things at the wrong time. And these mistakes are compounded over time, and mediocre results follow. The antithesis of mediocre, by the way, is an investing great. You know him by the name of Warren Buffett. So what could I possibly tell you about Warren Buffett that you haven't already heard? Well, I think I've got something. But before I tell you that, I want to share with you a letter that I received from him way back in 2003 when I was living in the Midwest at the time. And this is a letter that I received from him after sending him a signed Carl Yastrzemski baseball. Carl Yastrzemski, a legend in Boston circles, known as Yaz. He's in the Hall of Fame. And so what ended up happening is I had been collecting these Berkshire Hathaway annual reports, which I still have somewhere around here. And I wanted to get them signed by Warren Buffett. And so I figured, well, what could I possibly do to get his attention and also to show him some thanks for signing these Berkshire Hathaway annual reports. And so I ended up sending him the reports along with the ball, and I got back the reports and along with this beautiful letter, signed reports, a couple of weeks later. And so I just wanted to share this with you. It just gives you kind of an idea of how down to earth of a guy he really is. But getting back to consistency and Warren Buffett, and I think this is something that I don't think you've heard anywhere else. And I think it's something that makes Buffett's story so incredible and remarkable is that he amassed his great wealth without the help of a friendly stock market. And a lot of people don't know this. And this achievement alone, I think, is among the most ultimately and seldom discussed aspects of Buffett's greatness. And so I'm going to show you some numbers that are going to help you understand when this happened. So if we take a look at the stock market here in the U.S., the 16-year period from 1966 all the way to 1982, the Dow Jones Industrial Average, it did not perform well. It got clobbered in the 73, 74 bear market, falling around 45%, and it remained flat until 1982. Now, of course, you did have some dividends being collected all along, but seldom mentioned during this time frame of unfriendly stock market performance is how Warren Buffett, during the same time frame, which coincided with his age from 36 to 54, he still managed to grow his capital and his net worth 14,000% by turning $7 million into almost $1 billion. I mean, it's just crazy. And it's just crazy in a good way, of course. But I'm going to show you his multi-age snapshot of his net worth and this gravity-defying consistency, and that's the habit we're trying to emulate, this consistency that directly contributed to his wealth. And this is a remarkable feat because it's hardest to be consistently good when financial markets are consistently flat or falling. So you take a look at this from 36 to 54, that coincided with this 16-year period of flat stock market performance. Again, he still managed to grow his net worth 14,000%, turning $7 million into almost $1 billion. How did he do it? What's his secret? Well, buying and holding superb businesses. And this is the same guy that told us that we should invest in businesses that are so wonderful that even an idiot can run them, because someday an idiot will. So what's the translation? We want to idiot-proof our investment portfolio. But what do we know about the investing masses, including professional investors? Are they doing that? Well, as a group, they both consistently underperform markets market indexes linked to stocks and bonds and other major asset classes. The academic studies confirm this fact, and over longer periods of time, upwards of 90% or more of professional money managers fail to outperform their peer market index. So what's the lesson? This type of inconsistency, we as investors and our advisors, if we're using them, we should be eliminating this instead of embracing it. We should get rid of it. And if we do that, we're going to be much better off. The solution, and it's very simple, is to simply make index ETFs the foundation of your investment portfolio. That should be the bulk of where your assets and your serious money are parked. And this is a good start toward achieving consistent market performance. By just matching the market indexes, not only are you going to have greater consistency to your bottom line results, you're also going to simultaneously outperform the crowd, which still underperforms on a rather consistent basis. That's the wrong kind of consistency. So in the end, you don't need to become a great stock picker like Warren Buffett to obtain satisfactory outcomes that bring you closer to your financial goals. So what are the lessons? What should we as investors be doing? First of all, start with trying to have a good day. Then you have a good week. You follow that up with having a good month, and then you keep repeating. So we want to repeat our success. We want to have that consistency of positive outcomes over and over again. Build the foundation of your investment portfolio on market index ETFs. It's going to bring you greater stability, greater consistency, and as a whole, a lot less risk compared to stock picking and day trading. Eliminate habits and ideas that foster inconsistency. Understand that your portfolio's performance is going to either validate or invalidate the correctness of your investment approach. And then understand that realizing many consistent but small victories is often better than reaching for the inconsistency of one big victory or win. Refrain from overcomplicating your investment portfolio or strategy. Recognize that successful execution is harder when you complicate your investment approach. And obtaining positive results on a consistent basis, it just becomes that much more difficult when you have a complicated approach or complicated portfolio design. And remember that repeating mistakes, it creates the wrong type of consistency. So we want to catch that early, catch that fast, and get rid of it. So if you enjoyed today's episode, be sure to subscribe to ETFguide TV and check out my grading service at portfolioreportcard.com. You can also buy my book, Habits of the Investing Greats. It's available at amazon.com. I'm Ron DeLegge. Thanks for watching.